Maduro has stolen everything he could in Venezuela. Now he's looking across the border to steal whatever wealth remains with his neighbors. He doesn't have the balls to attack Colombia because they'd whip him in a minute.
Exactly. And we want to buy from him.
That's ironic too. I mean, we changed the U.S. Gulf Coast refining industry over intelligently, by the way, to produce low quality, sour, heavy crudes produced by Mexico and Venezuela, who can't produce them anymore. So what we've decided to do as a people is subsidize Venezuela when there's this wonderful country to our north, Canada, that produces low quality, heavy, sour crudes.
Hi, all. This is Andy here, and I'm speaking with Rick Rule with Rule Investment Media. And just a fun side story. I just informed Rick off camera that we met 30 years ago when I was just a baby, as he put it. And he gave me a tour around this conference, where he gave a bunch of us a tour around this conference. So, Rick, I am thrilled to have you on. It's an absolute honor. How are you?
I'm delighted. The better for your story. It's great to have the opportunity to inculcate young people. It's better yet to be able to keep them. So you made my day with that story. Thank you.
You're very welcome. So what I'd like to start out with is, as I explained off camera, let's start out with the macro view here. What did we see in 2023 and what are we looking at in 2024? And before we do it, real quick, before we get into that, I'm aware that you have a certain set of skills and experience as in the bond market or the credit markets, which is rare, going and also marrying that with metals. And in my background, the guys that traded the bonds or guys that were involved with interest rates were the smartest guys in the room. So let's start out with that, the macro here, 23 and going into 24 and what you're looking at.
Well, Buffett once said, if you're the smartest guy in the room, you're in the wrong room. So beginning with that stolen humility, I'll say that the macro is very interesting. First of all, I need to say that I am delighted with the relative strength in the U.S. economy. I would have expected that if you had doubled nominal interest rates, that it would have had a much greater negative impact on the economy than hitherto it has had. I suspect, although I hope I'm wrong, that the strength in the U.S. economy will be fleeting in the way it was in the 1970s, which is to say that the impact of higher interest rates will occur. It'll occur later than people have expected it might. One statistic which supports that thesis has been the slowdown in new home construction and the slowdown in new home sales without a rapid decline in single-family residential pricing. That would suggest that the sellers haven't been motivated, either because they don't want to give up a 30-year fixed mortgage that they put in place 3 years ago and couldn't replace, or because they have price expectations that were generated during a time of lower interest rates. While the buyers are expecting lower prices and can't afford to buy homes at 30-year fixed prices that exist today. Supportive of the thesis in the sense that while we haven't seen a decrease in price, we've seen a decrease in volume, which may presage a decrease in price. Suffice it to say, for the first part of the answer to the question, the strength in the U.S. economy in the face of dramatically higher nominal interest rates has surprised and delighted me. My suspicion is that we'll suffer a delayed punch. I think on a global basis, there's a few things that we need to think about. One is that a 40-year trend to increasing globalization and world peace may be over. Problems in the Middle East, which could spread or could manifest themselves. Problems in Central Europe. But problems in other parts of the world, too, suggest that the peace dividend that we've enjoyed as a species, both in a real sense and in an economic sense, may be over. That doesn't mean that I'm forecasting a return to world war. It just suggests that the benign global climate that existed in the last 40 years may be coming to a halt, at the same time that the benign fiscal climate brought in by lower nominal interest rates may be coming to a halt. Is the world coming to an end? Of course not. But I would suspect that we've been through the 40 most benign economic years in human history. And I suspect that the next 10 years will be less benign and less pleasant. Not forecasting doom and gloom. I'm just saying that the outlook is less rosy going forward. In terms of the resource part of macroeconomics, we have lots and lots and lots of. Actually, before we do resources, just for fun, let's do fiscal policy because
Please.
I think that's very important. There's been a lot of discussion that the U.S. dollar will be replaced as the world's reserve currency, and I would say to you at age 70, not in my lifetime. The U.S. dollar is, as Doug Casey argues, the worst currency in the world, with the sole exception of all of the others. It's interesting, given all the challenges that the United States faces as a society, that our currency has been a store of value compared to the competitors, which suggests that they're winning the race to the bottom, a race that I'm delighted to not be participating in so well. But I think if you look at the strongest currency in the world in isolation, and you think about its prospects in the next 20 years, relative to its prospects in the last 40 years, that you have some cause for concern. The first is that 40 years ago, aggregate federal government debt to GDP stood at 22%. Today it stands, depending on who you listen to, at 115%, which is to say we have less fiscal tools as a people to deal with our difficulties than we did 40 years ago. At the same time that we have more complacency and more confidence, a dangerous combination in my view. Quantitative easing. Andy, if you did it, it would be called counterfeiting, and you would be thrown in jail. The printing of more specious currency units unbacked by anything, where you don't even have to print them anymore, you can conjure them up on a computer, is counterfeiting, irrespective of who does it. Making new currency units unbacked by anything does not make the existing currency units more valuable, but rather less valuable. And your ability to continue to do it is a function of confidence, which I suspect will be called into question. But that isn't the worst problem that I see. You move from there to debt and deficits. And there, the problem is more complex, I think, than your viewers understand. Debt, in the first instance. People look at the on-balance sheet liabilities of the U.S. government, the liabilities represented by the Treasury market. $33 trillion in gross debt, $27 trillion in net debt, net of counterfeiting, by the way, net of the Fed's balance sheet. The $26 trillion number, we propose to service with a budget that's $2 trillion a year in deficit. I don't understand how you add a column of negative numbers and come up with a positive sum. I'll leave that to Congress, but I think it's a measure of concern. But of greater concern, your viewers can look at by looking at my picture on the video screen, which is to say an aging demographic. Specifically in the United States, the off-balance sheet, the net present value of off-balance sheet liabilities in the United States exceeds, by the estimate of the Congressional Budget Office, $120 trillion. Now, this might be of less concern to a 70-year-old because he's a beneficiary of this intergenerational theft. But were I of your age, I would be particularly concerned about a group of old baby boomers who voted themselves a bunch of benefits and forgot to pay for it.
Right.
We're attempting to leave you the bill, and I
Right.
wouldn't like it if I were you.
No, I don't.
And if I were your audience. But I think irrespective of your generation, you need to look at this as something that makes you less rather than more sanguine. But I would suggest that for American savers, there's a bigger cause of concern. Well, maybe not a bigger cause of concern. Maybe it's an outcome, but inflation. You know, the big thinkers, Andy, would have you believe that inflation, which is to say the deterioration of the purchasing power of your savings, is measured by the CPI. But that's a lie. The CPI, first of all, is a constructed index, hedonistically adjusted, which means that the big thinkers decide what your computer is actually worth, not what you paid for it. And they decide what your house is worth, too, not what you paid for it. In addition, when it's inconvenient to them, they don't include food or fuel. I guess if I didn't have to eat, I'd feel less constrained by that index, but I do, as you can see. But the most obvious difference I have with the index is that it doesn't include the cost of government. For most American families, working American families, tax is a larger expense than food, shelter, transportation, and energy combined. And an index, a cost of living index, which doesn't include the cost of government, is spurious at best. Now, I understand a goods and services index represents services, and these aren't services that I consume voluntarily, but I consume them nonetheless. When I do the arithmetic around the basket of goods and services that I purchase, and I'm old, I have everything, and I'm cheap, and I don't spend money. But when I do it nonetheless, what I find is that the purchasing power of my savings is deteriorating by about 7% compounded. So if we want to be concerned about something as American savers, look at the fact that the world's preeminent savings instrument, and the one that we finance our lifestyle on, the U.S. 10-year Treasury, purports to pay you, as of today's interview, at about 4.2%.
Right.
In a currency where the purchasing power is declining at 7% compounded, which is to say, the U.S. government solemnly swears, if you loan them money for 10 years, to reduce your purchasing power by 2.7% a year compounded for 10 years. Return-free risk, my friend Jim Grant calls it. At any rate, it's probably the first promise they've made me in my 70 years on Earth that I absolutely believe that they will keep, and not one that makes me sanguine. So I think we've dealt with the macro part of politics and the Commonwealth. Let's move on to resources, where we have competing themes. One theme,
really, but yes, I know what you're saying. Yes,
one theme is a changing of the economic circumstance from a benign circumstance of 40 years to a more constrained circumstance. Now, rising interest rates, increased costs of capital, less peace, a less good thing. The second is the specter of recession. I'm not an economist, I'm a credit analyst. I can't tell you if we're going to have one or if we're not going to have one. I do know from looking back in my life that every 10 or 15 years we seem to have had one. And if we haven't obviated history in the last 40 years, perhaps it's likely we have another. I can't tell you. Your listeners will have to decide that for yourselves. Both of those are negative for resources. What's positive for resources? Well, for 30 years as a species, we have underinvested in natural resources. We've underinvested in exploration. We've underinvested in development. We've increased the social rent, which is to say we've stolen more of the free cash flow from natural resource activities than we ever have before. So we have an inescapable supply crisis. We have a supply crisis in oil and gas, which would surprise the big thinkers. We have a supply crisis in copper. We have a supply crisis in agricultural materials. Mm-hmm. If we don't have a recession, these declining supplies will result in higher, perhaps sharply higher prices. If we have a recession in the near term, you can have reduced supplies if you have reduced demand and you don't move the commodity price. So I'll leave that up to your listener. The other thing that we have is we have an increasing political consensus and voter consensus, I guess, that resources don't matter. The big thinkers of the world, the Joe Bidens, the Justin Trudeaus, that noted energy physicist, Greta Thunberg, would have you believe that peak energy demand, carbon energy demand, will occur in 2032. 2032,
yeah.
Which is an abject lie. Your viewers will be interested to know that we have spent in the last 40 years $5 trillion on alternative energies, and we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. $5 trillion resulted in a 1% decline in fossil fuel demand. At the same time, we have 1 billion people on Earth, 1 billion people on Earth who has no access to primary electricity. 3 billion people on Earth have aggregate electrical consumption equal to 1 U.S. refrigerator per day. As we witness the ascent of humankind, which I hope and pray we continue to witness, we will see aggregate demand increase for all forms of electricity. Solar, of course. Wind, why not?
Sure.
The fossil fuels too.
Sure.
We are, as a consequence of the political narrative, ignoring uh, any laws of thermodynamics,
Yeah,
uh,
right.
ignoring the fact that, well, let me rephrase it, causing the fact that the oil industry worldwide is deferring $1 billion a day in sustaining capital, $365 billion a year. When the industry defers to sustaining capital, they reduce their ability to produce, which is to say, with declining supplies, prices go higher in the face of stable demand. But we're not going to have stable demand. We're going to have increasing demand.
Mm-hmm.
And I use oil not necessarily to tout oil, but rather to talk about the inconsistency between reality and the political dialogue, and also to talk about how perception and politics impacts commodity pricing and returns on capital employed in commodity businesses worldwide.
Yeah. That kind of fits the narrative, I guess, with like where oil, I guess I used to oil as a proxy, but where that is right now currently, because I'm shocked. I mean, what I won't say for better or worse, right now at this day, we're at about $72 a barrel. With everything you just said going on, plus two wars, well, you even mentioned those. And one of the wars being an absolute hotspot, the other one being in a very commodity, um, I don't know, sensitive area. It seemed like the price of oil would be significantly higher.
Well,
Uh,
markets work, remember. We took the price from, well, we took it from zero in the COVID days, but let's say 20 to $30 a barrel. We took it
right.
from 20 or $30 a barrel to $90 a barrel.
Yeah.
And that's in US dollars, the strongest currency in the world.
Right.
If you think of about what happened to the oil price in Argentine pesos,
Yeah. Yeah.
or in euros, or in yuan,
Yeah. Or in the
what
yen.
we
Yeah.
what we saw was that markets worked, and these increasing prices have resulted in a decline in consumption at the same time that they've resulted near term in an increase in production, at least American production.
Mhm.
And it
Right.
wouldn't surprise me to see the oil price go momentarily from $72, perhaps as low as $50.
Mhm.
That's the way markets work.
Mhm.
But when you're deferring $1 billion a day in sustaining capital, there is
Mhm.
absolutely no doubt in my mind that you constrain supplies going forward, at least non-US production. And I think that's what's going to occur. You're looking at the production cuts announced by OPEC recently.
Yeah.
Venezuela can't make their quota.
Yeah.
Mexico can't make their quota. Nigeria can't make their quota. Indonesia can't make their quota. I mean,
Yeah.
talk about something that's artificial.
Yeah.
Uh,
Yeah. The Venezuela just recently, I want to make sure I get this correct. I mean, they're banging the war drum, because
yeah,
because of oil, if you would. So
Maduro's stolen everything he could in Venezuela. Now he's looking across the border to steal whatever wealth remains with his neighbors. He doesn't have the balls to attack Colombia because they'd whip him in a minute.
exactly. And we want to buy from him. Which
That's ironic too. I mean, we changed the U.S. Gulf Coast refining industry over intelligently, by the way, to produce low quality sour heavy crudes produced by Mexico and Venezuela, who can't produce them anymore. So what we've decided to do as a people is subsidize Venezuela when there's this wonderful country to our north, Canada, that produces low quality heavy sour crudes.
Right.
Why we're going to Maduro when we could go to his ideological soulmate, Trudeau, another pinko,
Mhm.
and buy the resources we need from Canada as opposed to Venezuela, absolutely confounds me.
Yeah, me too. And nobody dies. So, so let's get to that. Okay, so we have a crisis or a brewing crisis in oil and crude. So that obviously has implications for other sources of energy. Top of my mind, uranium and coal. Now, I bring up uranium because that's a very interesting play, if you would, an investment, if you would, because I remember I was one of the few, I don't want to say few, I was one of the people that didn't pull the trigger, but I was very interested. And then now we've had this huge, well, yeah, I don't want to say huge, but a significant run up. And me, I do have some experience in this. You usually sell the rip, right? Um, I'm like, I'm concerned now, not concerned, but I'm just, to me, it's no longer cheap enough, I guess, uranium. I wanted your thoughts on uranium and if that's still a play that you'd be interested in.
Complex topic. The easy money has been made.
Mhm.
The easy money has been made when a commodity goes from selling for less than the cost of production to a price that's high enough that the industry is earning its cost of capital. And when the
Mhm.
theme itself goes from hated to tolerated. So the easy money has been made in uranium. The consequence of that is that I have sold enough of my speculative uranium juniors that I've recouped all my capital and I've paid the capital gains tax on the gains that I've enjoyed. But this higher price for uranium doesn't result in increased supplies in the near term because you have to permit mines, you have to finance mines, and you have to build mines. The move in the uranium price from $20 a pound to $75 a pound doesn't increase the supplies of uranium, at least new mine supplies, for 7 to 10 years. It does increase not byproduct supplies, pardon me, but mothballed supplies in Canada and Kazakhstan. It increases supplies by about 30 million pounds against a market that's in deficit by 50 million pounds. What's changing in the near term is still bullish for uranium. The first is that the above ground inventory, that is to say, the inventories that we have that have shielded us from the production deficits, were primarily in Japan. But the Japanese have returned their nuclear fleet or are returning their nuclear fleet to production. So that supply goes from held for sale to held as fuel. And the rest of the above ground supply, at least an awful lot of it, was bought by my former employer, Sprott, who bought 46 million pounds. That supply went to supply heaven. So my suspicion is that with the migration of most of the uranium from the spot market to the term market, which locks in producer price certainty around sales, that there is still good money to be made for 5 years, or at least 2 years, in the uranium space. The easy money has been made. The sure money is there to make now.
Got it.
I don't need any longer to buy any uranium. I don't need to buy the Sprott Physical Uranium Trust. I have it coming out of my ears. I don't need to buy Kazatomprom or Cameco because I have lots.
Right.
I don't need to buy the uranium juniors because I'm selling them.
Right.
But most of the investing world, until 6 months ago, couldn't spell uranium. Or if they could, they didn't like it because it disappointed the expectations they had for it in 2019, 2020. The
Mhm.
easy money has been made, but there's still money to be made in the sector if you care to make that kind of money.
Yeah. It's kind of interesting too, because I saw the big players they ran, but the little guys, the juniors, if you good, most of them just significantly outperformed. And so really my question to you is like somebody that's late and that doesn't want exposure to uranium, would they go with the bigger players like the Chemicals or whatever, or would they look at some juniors, if you would?
That depends on the person. If
Sure.
you're a speculator, if you're willing to work hard, which is what you have to do in the juniors, and if you're willing to use volatility as a tool as opposed to recognize it as a risk, you can be in the juniors.
Mhm.
I've learned over 50 years that natural resource markets are capital intensive and cyclical, which
Right.
means that owning the market beta in a bull market gives you such ludicrous results for 2 years out of 10. I think we're into that 2 year period. That you don't need to generate alpha. You just generate beta. So for most people, buying Cameco is all they need to know. For people who don't want to work but want better results than just Cameco, uh, 10 years ago, I wouldn't have told you this, but I think you buy the ETF. I don't like the ETFs because the ETFs charge me a fee to own sort of 20 stocks out of a 50 stock universe that I wouldn't own with a straight face. But what I've learned is that the market beta doesn't care what I like. And they don't care about what I think is neat and proper. The idea that you buy the ETF, you expose yourself to the space, and you don't do any work. You go on about your life, work your job, look after your kids, read books, whatever you like to do, suddenly makes sense to me. There are a lot of people that are scared out of the uranium space because they don't want to work as hard as I do.
Mhm.
Them, they should be involved in the space, but they should look at the ETF.
Got it. Okay. Well, let's talk about other forms of energy then, like coal, or even wind or solar. What are your thoughts on that? And yeah, what are your thoughts? And like, and like,
Let's take them in reverse order.
yeah.
I've made money on alternative energy.
Mhm.
I need to say, somewhat embarrassingly, that I haven't invested in them as energy. I've invested in them as a way to steal money from ratepayers and taxpayers, um, which is to say, that uneconomic propositions were made economic by the legislature. And I
Right.
was smart enough to do the
I got
arithmetic.
you. I got you.
Um, but solar doesn't have a place in Toronto or Hamburg or Stockholm where the sun doesn't
How
shine.
much you know?
It works in Las Vegas, it works in Phoenix, and it
Right.
works in places where the legislature is willing to steal from the electorate, like Germany.
Yeah.
Similarly, wind works in Lethbridge, Alberta, but it doesn't work in Vancouver. It works where the wind blows. Okay.
Mhm.
So yes, you can be in those. I would suggest that you wait a few years until the wind comes, until the bloom comes off the rose.
Right.
But if you're looking for forms of energy that are hated,
Mhm.
places where you can make money today, those are much less glamorous. Coal. Glencore recently bought in 40% interest in a mine in Colombia that they don't own, that they didn't own. It was a minority shareholding. One of the largest coal mines in the world, one of the lowest all-in cost producers in the world. 35 years of reserves left, and they bought it for 1.5 times cash flow. Something like a 50% earnings yield, which of course they funded at their cost of funds, which is prime, so 5.75%. Stupidly good deal. People say, but coal's going to go away. The largest year in history for coal demand was 2022. 2023 eclipsed it in October.
Right.
The Chinese are building coal plants. The Indians are building coal plants. They're building coal plants around the world. Whether or not Greta Thunberg likes it, poor people, when they hit the switch, want the lights to come on. They could care less about what Greta thinks they should burn.
They want a warm home in the winter.
If you don't want to be involved in a pariah, if you don't want your grandchildren to cuss you, there's a halfway house. It's called North American Natural Gas.
Yeah.
There is a net economic, not economic, there's a net carbon benefit to switching from coal to natural gas. The big thinkers don't want to do it because they don't like natural gas. Half measures don't work. They want you to be poor. But let's move on. There's an arbitrage in North American natural gas that's stupid in financial terms. Natural gas in Texas or up in Alberta sells for about $3.50 per million British thermal unit. That same gas as LNG or CNG in Tokyo or in Frankfurt sells for $8.
Yeah.
It costs $1 to get it there. This arbitrage is too big to last.
Right.
There's a surplus of North American production in Canada because the Prime Minister doesn't like natural gas and he won't let it be exported from Canada. In the United States, because we're producing so much natural gas as a byproduct of oil drilling, that there's a surplus of natural gas. These low prices create demand. They create infrastructure. This arbitrage between the international oil price and the U.S. natural gas price will compress, and it will compress with natural gas going higher, not oil going lower.
Right.
These companies have names. You don't need to go to the smallest, gamiest players. There's enough money to be made on beta. Names like Devon in the U.S. Southwest, names like Equitable in the Marcellus in the Northeast, names like Peyto, Birchcliff, Tourmaline, and Arc in Canada. You don't need to go to the penny dreadfuls. You can lock in 5 and 6% dividend yields and wait for time to be on your side for this arbitrage to be eliminated. Will you experience volatility? Yes. Will the stocks go up? No. Could they go up? Could they go down before they go up? Yes. But in the 5-year time frame, getting paid 5 or 6% to wait for something that's inevitable, despite the fact that Greta doesn't like it, seems like a pretty good deal to me.
Yeah, no, it seems like a great deal to me. And I'm not up to my eyeballs in natural gas, but I'm up to my chin.
Good for you.
Good
for you.
I really like natural gas. Let's talk about industrial commodities, if you would. And what's interesting to me is it's somewhat similar to what uranium was, I think. And what I mean by that, it seems like there's not a whole lot going on. It's not sexy. I'm talking about copper and nickel specifically. It's been pounded into the ground. And yet we have an infrastructure problem here in the US. So that would seem like they would need a lot of things like copper and nickel. There's an EV market and that's cratering, but there is an EV market that needs these metals. And then you have just a world economy that is recession be damned, that is growing. And again, you're looking at 5 to 10 years out, they're going to need these things. So talk to me about industrial metals. I just think that one day it'll be similar to uranium. We'll wake up and it's really moving, and we got to get double or triple here within the next several years, for a few years, if not sooner. So what are your thoughts on
I
industrial
don't
metals?
regard industrial materials as a monolithic market. I regard them as 60 markets. And so let's look at a few of the markets you've talked about. Nickel,
Yeah.
which is very different in terms of supply and demand than copper.
Okay.
Nickel is in the near term going lower.
Okay.
It's going lower for two reasons. The first is that many people may know that the Russians need cash. They're
Yeah.
selling everything that they have in their cupboard, which includes
I
a
didn't
lot of.
think, yeah.
So they're selling nickel like they did in 90 and 91, where they brought the price down 30% by dishoarding. They're
Got it.
selling whatever has a bid, and nickel has a bid. But the second thing that's happening is that lateritic nickel production in the Philippines and Indonesia is increasing very rapidly.
Mhm. Okay.
Nobody will mistake me for a rabid environmentalist, but the production practices around the lateritic nickel deposits in tropical terrains in Southeast Asia, are horrific. And my suspicion is that those societies will not take the uncompensated environmental damage that's occurring in those societies much longer. The same way that the Chinese in Western China aren't taking the environmental damage any longer that led to low rare earths. I suspect that you have 2 more years of increased nickel production, and then you have rather precipitous nickel production declines because you won't see the increase in lateritic nickel production, and you'll see the Russians, not having any nickel left to sell, while being able to produce less as a consequence of their underinvestment in productive capacity for nickel. So nickel lower, then higher.
Sounds like a great potential opportunity over the next 24 months then.
I agree, because I think people are going to hate nickel. People who bought into the nickel story in 2020 are going to think nickel was a 4-letter word.
Right.
It's selling for half what they paid for it, which is lovely from a new investor's point of view.
Right.
Copper is a different circumstance. The only thing that can keep copper back is a recession.
Okay.
If you look at the copper mines in the world, with a few exceptions, sadly, they look like me, 70 years old, past their prime. These things were discovered in the 30s and 40s, put in production in the 60s or 70s. You don't stand on the pit wall, throw in fertilizer and water, and have it grow more copper. That's not the way it works. Largest copper mine in the world, Escondida, 45 years of age. Second largest and best copper mine in the world, Grasberg, 45 or 50 years of age. Chuquicamata, the biggest historic copper mine in the world, 120 years of age. Bingham Canyon, largest copper mine in the U.S., 160 years of age. At the same time that the world demand for copper is increasing, and by the way, it's not all electric vehicles. Bringing electricity to the poorest of the poor is a bigger use.
Sure.
Means that we need more and more and more copper. And we're 30 years late making these investments. And the investments that we make are delayed. There's a wonderful deposit here in the United States called Resolution in Arizona. It was discovered 30 years ago. It's been in permitting for 24 years. 1.5 billion tons of 1.5% copper. Average mine grade of copper worldwide is 0.5%. So 3 times the average grade in the world. 1.5 million tons, located in copper country, by a paved road, lots of water, lots of power, lots of copper miners. Been 25 years in permitting. It has at least 5 years of permitting to go. If we went out and discovered a copper mine today in the United States, heaven forbid, it would take us 25 or 30 years to have that mine impact supply. Mercifully, the places that we're finding copper now, Zambia, Kazakhstan, Congo, the places that are allegedly politically risky, you can build a mine.
Right. I want to get to that in a minute too. I have a really good question about that. So if you, again, depending on the person's risk tolerance, well, let me just say this: where's Rick Rule play in that, or where are you interested in? What are you interested in?
If you're talking about political risk,
Yes.
I believe the riskiest government is that which is closest to you.
Okay. So you're not playing North America then?
I am. If other people view political risk differently than mine, and so the cost of capital in North America is lower.
Okay.
So I discount foreign net present value by the delta in their cost of capital between U.S. and Canadian cost of funds
Mhm.
and Congolese or Indonesian costs of funds. So I'll take a lower economic return in the United States, not because I perceive the United States as less risky, but simply because my input costs in the United States are
Right.
lower.
Got it.
The worst experience of political risk I ever had personally was in California. We discovered a mine called Castle Mountain in 1981, and it took us until 1993 or 1994 to get the thing permitted. It cost us $16 million in bribes. They were called campaign contributions then,
Right. Yeah.
contributions in lieu. And if you know anything about finance, cash flow that's delayed by 13 years at a 7% discount isn't delayed, it's gone.
Mhm.
So something like $700 million in net present value of cash flow was deprived, we were deprived of by the California legislature. And people tell me Congo is risky.
Right. Right. So that leads me to like, where is that on your, I guess, hierarchy of where you'll go? Well, maybe a better question: is there a place you won't invest money, a geographical area, whether that's a country or a state?
I mean, right now, despite the fact that I've enjoyed very good returns there over time, I can't go to Russia.
Mhm.
It's just too cumbersome for me. And as you can tell by my shirt, I have a bank in application with the FDIC, and I think if I were seen to be investing in Russia, it wouldn't be good for my application
Right.
with regards to the
Right.
bank. So I won't go to Russia. The Chinese have decided that they can do without outside resource developers. So although I would go to China, the Chinese won't have me. I certainly would not, under any circumstances, try to build a mine or drill an oil well in California, Oregon, or Washington. I wouldn't do it in British Columbia if I wasn't in Taltan. That's the name of an Indian band. If I wasn't in Taltan land, there's a lot of places I wouldn't go. In the United States, I'm comfortable in Texas. I'm comfortable in Wyoming. I'm comfortable in Alaska. I'm comfortable in Nevada. I have real problems with the rest of the states.
Got it.
Countries that are improving, from my viewpoint, albeit from a very low base, Argentina is improving. The most recent presidential elections show at least that they've identified the problem, not necessarily that they're willing to solve it. I think Brazil is improving. I think Congo is improving. I think Namibia and Botswana are improving. I think Kazakhstan, Uzbekistan are improving, albeit from low bases.
Mm.
I look at places that are getting better,
Right.
places that are stable, but are attractive, maybe not for reasons that I like, include the province of Quebec in Canada,
Mhm.
where the government seems to be willing to steal from the rest of the citizenry to subsidize me. I'm not saying that's a good thing, but it's better, I guess, to have them steal from other people than to have them steal from you, given that their one constant is theft. Political risk is challenging. I think Mongolia is improving, albeit the opportunities to invest there are fairly constrained. If you were looking at a major economy that I think is getting demonstrably better, despite the election of a Pinko as president, it would be Brazil.
Brazil. Got it. Well, let's talk about gold and silver in light of your macro your macro views. Um, I listened to you again for 30 years, and you're a relative gold bug, if you would. And I say relatively, I mean that is in the best way, in the best way. Yeah, we have a lot of things going on. It's currency devaluation, debt. et cetera, everything you just said. Um, Talk to me though about the gold miners, the leverage that you have and what you're looking for, or where you're at with some gold miners.
Tale of two cities. The gold mining industry has been an amazing destroyer of capital over time
Yeah. Oh,
because the industry has been priced for optionality. Everybody's bought it
yeah.
in the concept of an increased gold price.
Right.
So they've asked companies to be able to expand their margin when the price goes up. What a tough chore.
Right.
They haven't asked them to be efficient. My first impression of the gold mining business, if you look back to the period 2000 to 2011,
Mhm.
the gold price went from $256 an ounce, I think, to $1,900 an ounce.
Yeah.
And the free cash flow per share of the gold index fell. Now, how could they do that? How could they take a sevenfold increase in the selling price of their product and deliver lower free cash flow per share? That took real skill. They should have put those guys in Congress. I hope, I know that the management teams that were responsible for most of that deterioration in value have been allowed to pursue other employment opportunities. And I know that investors like myself are holding the companies to account better, particularly bigger investors than me. And the gold mining industry, by most metrics, enterprise value to net present value being my favorite,
Mm.
are the cheapest that they've ever been.
Yeah.
And so, while I'm not willing to forgive them their past sins, my greed is beginning to overwhelm my fear simply because I believe the gold price is going to go up. And I believe that for the next 3 years, at least, that the companies will be forced by the investors to be rational. I don't think they'll be rational of their own volition.
Mhm.
Being rational is no fun. Being expansive is fun.
Mhm.
But I think that they'll be forced to be rational because investors' perceptions of the gold industry were shaped in the period 2000 to 2011. And investors believe, despite the fact that they think the gold price is going higher, that the gold mining companies will waste all the money. And I
Right.
think they'll only waste some of the money.
I guess you could probably say the same thing with silver in that maybe that's even more extreme because I don't see a whole lot of silver, just pure silver producers out there anymore.
Very different industries. I
Yeah.
own gold personally as an insurance asset.
Yeah.
I don't own it because I think it might increase 10% in price.
Mhm.
I own it because I'm afraid it's going to triple or quadruple.
Yeah.
The circumstances that would cause it to do that would be difficult elsewhere in my portfolio. So I really, truly own gold as insurance. And I own many of the gold mining shares that I own as investments. Silver is speculative. As you point out, it's difficult to forecast supply because new mine supply is only 18% of mine supply. The rest is byproduct of other commodities. So to know about supply, you need to know about copper production, lead production, zinc production, and gold production.
Mhm.
Difficult to do. I own silver as a speculation, and I own silver stocks because outside of technology, they're probably the most volatile to the upside group of stocks on the planet. The population of viable silver companies and the market capitalization of viable silver equities is so small that if and when the narrative turns to silver and the generalist investor comes in the silver space, there isn't enough market cap in that silo to contain the money. My first decade as a resource investor in the 70s, I watched, sadly without participating, the shares of Coeur d'Alene mines go from 10 cents to $65. I participated in the early 1990s in Pan American silver going from 50 cents, where, by the way, I got a warrant, to $45. I watched Silver Standard go from 72 cents to $45. The upside in these silver stocks in a silver bull market is something to behold. Will we have a silver bull market? I don't know. What I do know is that they're roundly hated. And I can buy positions right now with virtually no competition.
Right.
And if they make the progression that uranium made from hated to tolerated,
Right.
there is an awful lot of easy money on the table.
Yeah.
Now, at age 70, am I making a huge bet? about 2.5% of net worth. My suspicion is that that 2.5% wager becomes 25% of my net worth in the 5-year time frame.
Yeah, that'd be a beautiful thing.
That's the kind of disaggregated bet that I like to see.
Yeah.
Do I
Got
think
it.
it's a certainty? Absolutely not. Is it enough of a possibility, given the outsized nature of the return, that I can't resist, even though I don't need the money? Yes.
Got it. And really, and finally, and I'd like to ask you, how do you, I mean, this is a very complex question, but how do you, or how, what do you prioritize, I guess, when you're looking at or evaluating a company? So let's say something comes across my desk and I see, hey, the founder has XYZ or so many years of experience. They have so much cash in the bank. They're mining they want to build a mine or look for gold or silver or whatever, uranium or oil in a friendly jurisdiction. What makes something interest you, if you would, and what boxes do you check?
It depends on the size of the market cap. Depends on if I'm investing or if I'm speculating.
Well, let's start with speculating. Go ahead.
If I'm speculating, I start with people.
Okay.
A summary of Pareto's law for those listeners that you have that don't understand what it is. That's the social science dictum that says that 20% of the population generates 80% of the utility, the 80-20 rule.
Right.
It's important to know that one part of the population does in fact generate 80% of the utility. A different part of the population generates 80% of the aggravation. So the first choice that you have is to find the good 20 and avoid the bad 20. The second thing around people is to understand that this is a performance dispersal curve. And the performance dispersal curve is repeatable at least twice, which is to say that 20% of the 20 generate 80% of the 80, or 4% of the population generates 64 or 65% of the utility. And 20% of that 20 generates 80% of that 80, which is to say less than 1% of the population generates 40% of the positive utility. If I, as a speculator, had just kept doing business with people who were responsible for major wins for me in my 20s and 30s and never done business with anybody else, I would have worked half as hard and made 4 times as much money.
Yeah.
So look for a track record of success, and look for a track record of success that's been achieved at the task at hand. If somebody has been successful in plastics, don't back them in natural gas exploration. They're different businesses.
Mhm.
Commodity. Look for a commodity, if you can, that's selling worldwide at a discount to the cost of production. Look for a commodity in liquidation, because in order for society to enjoy the utility produced by that economy, the price has to go up. This is real simple stuff.
Yeah, it becomes a math issue then.
And pay attention
Mhm.
to scope. Everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can never make you big money. If you're going to take the risk,
Okay.
get the reward.
Mhm.
Politics comes in fourth. It turns out, and I'm just going to say this politically incorrect fact, people that look like you and me believe that money that's stolen from us by white males in the legislature is somehow less gone than money stolen from us by darker hued people in less formal environments. But it's not. It's just as gone.
Mm.
My highest returns on capital employed, and frankly, my most consistent returns on capital employed, have occurred in places like Chile, Peru,
Mhm.
Congo, South Sudan, and until very recently, when it didn't, Russia.
Right.
So look at people, look for commodities out of favor, not in favor. Remember that markets work. High prices is the cure for high prices. Low prices is the cure for low prices. So look for uranium when everybody hates uranium. Look for coal when everybody hates coal. After commodities had a 500% share price increase, and you can find lots of reasons to like it, like lithium, understand that gravity is going to take over. It's going to come back to Earth. And pay real attention to the jockey. It's the jockey that brings the horse across the finish line first.
Got it. Excellent. Well, Rick, I don't want to keep you any longer. You've been just so gracious with your time. Just really want to thank you, and just tell us what you're doing real quick, what you're doing now, and how can people get in touch with you?
I'm doing really 4 things people should pay attention to. The first is Rural Investment Media. If you like what I have to say about natural resources and you want to make it personal, go to ruralinvestmentmedia.com. No fee. List your natural resource stocks. I'll personally rank them 1 to 10, 1 best, 10 worst. And I'll make individual comments where I think my individual comments might have value. Secondly, I have another free service called the Rural Classroom, ruralclassroom.com. 200 hours of educational programming, including 9 short courses on resource company valuations and resource company security analysis. Go to the Rural Classroom. Learn how to evaluate your own portfolio. Learn how to separate the wheat from the chaff. In addition to that, every 3 months, I put on a virtual boot camp. We've done boot camps around uranium when it was out of favor, silver, which is still out of favor, royalty and streaming companies. We have an upcoming one on development companies after the pre-feasibility study, but before they've gone into production. We charge $99 for these boot camps, 8.5 hours of intensive programming. Absolute world-class faculty, always 4 exhibitors that are in my own portfolio. Doesn't mean they'll go up in price, sadly, but it means that I know them well enough that I own them. And the $99, if you don't think you got your money's worth, is fully refundable. In other words, the financial risk is mine. And by the way, if you come to the boot camp, it's not a one-off. We're going to give you more information in 8.5 hours than you could possibly absorb. So you will have access to the conference tapes for a year. Watch the conference 4 times and use the lessons that you learned at the Rural Classroom to beneficiate your participation in the boot camps. In other words, learn the lessons that you've learned to get the information that you receive at the boot camp and make it more meaningful to you, and use it on the exhibitors. Don't like the exhibitors because I like them or because the speakers like them. Use the lessons in the Rural Classroom to determine whether or not you like them. Whether you do or not, the process will make you a better investor over time.
Excellent. All right. Well, thank you again so much, Rick. I'll put all of that in the show notes. I'll put links to all of your sites and everything you talked about. And again, it was an absolute pleasure of mine.
Well, my pleasure. Thank you for being an applied student these 30 years. It makes an old man happy.
You're very welcome. Have a great night.